Let's examine problem 12.3b. More ratios for us. We're going to be completing this big, long ratio table for the problem. And in fact, why don't we just jump into it by starting to do ratios? The first one we're asked to do is the current ratio, current assets divided by current liabilities. So we're going to go on to our balance sheet. We're going to find the total current assets. And where are you? Total current assets. There you are. We're going to find the total current liabilities. Total current liabilities. And for 2029, we're going to take the yellow one divided by the blue one for our current ratio for 2029. So it's 801,000 current assets divided by current liabilities, 155,000. And we get 5.17. Our current ratio tends to just be a number, so we don't have to put a percent or a dollar amount. It's just 5.17, and there's my current ratio for 2029. Let's do the same for 2028. So the yellow one for 2028, of course, divided by the blue one. 855 divided by 345. 2.48, and something I should add to my table here, and I'd suggest you do, is just B/W. Is this getting better or is it getting worse? And a rule of thumb for us is for the current ratio, bigger is better, and maybe bigger is better is the wrong turn of phrase. Bigger is safer, and for us, safer is better. So that's getting better. The next ratio, and so we introduced the current ratio in like chapter 1, and the idea of the current ratio is, do I have enough short-term assets to pay my bills, right? Am I covered, essentially? Well, some smart person looked at this and they maybe saw a company or two fail that had an okay current ratio, and they thought, wait a minute, if they have a lot of prepaid insurance or they have a lot of inventory that they can't sell, right? They're just stuck with some bad or old slow-moving inventory. That doesn't help you pay your bills, right? Cash pays your bills. Receivables, most companies do pay if you're owed money, so receivables help you pay your bills. And if you had a bunch of Microsoft stock, you could sell it. Short-term investments help you pay your bills. So why don't we, rather than taking all the current assets, including inventory and prepaids, why don't we just take the very liquid current assets, total them up, then divide by current liabilities, rather than taking all the current assets? So let's do that. Our acid test ratio is the cash, short-term investments, which would just come below cash if we had it, and accounts receivable, net receivables. And we're going to add up the yellows and divide by the blue. So adding the yellows here, 175 plus 61 is, what is that? 236. And 220 plus 150 is 370. And we'll just take the yellow, divide by the blue. So 236,000 divided by 155,000. 1.52. And for the year before, 370 divided by 345, 1.07. So you can see that the acid test ratio is going to be lower always than the current ratio. The rule of thumb for the current ratio, I don't know if you remember from way back in chapter 1, we said 1.5. If you're above 1.5, you're generally thought of as safe. The acid test ratio is anywhere above 1. Well, it's 0.9 to 1. Anywhere above that, you're thought of as safe. So this company is fine in all counts, but we would say its liquidity position is bigger in 2029, and therefore we're going to say better. Okay, let's move on to inventory turnover. So as far as liquidity goes in total, right, both ratios are better. I think this company is doing better as far as liquidity goes. For turnover ratios, cost of goods sold divided by average inventory. So let's highlight those. Cost of goods sold is, of course, on the income statement. I'll highlight it here in yellow. So that's going to be the numerator. The denominator is average inventory. This is something I always screwed up as a beginning student. The average inventory for 2029 is the average of these two numbers. The average inventory for 2028 is the average of these two numbers. Now, why is that the average? And the reason is, let's take 2028, for example. We ended 2028 with 450 grand. We ended 2027 with 400. Why was the average of those two numbers? The reason is 2027, the end of that year, is the same as the beginning of 2028. So we're saying we started 2028 with 400 grand in inventory. We ended with 450. The average inventory for the year is 425. And again, just add them together, divide by 2, right? 400,000 plus 450,000 equals divided by 2. That's how we get the average of 425. 525 plus 450 divided by 2, our average is 487,500 for 2029. That's our average. So I'm going to take the yellow number, cost of goods sold, divided by average inventory, which is the blue number here. So let's do it for 2028. 650 divided by 425. I get 1.53 times. Inventories turn a number of times. 1.53 times. And the year before, 900, or the year after rather, 900 divided by 487,500. 1.85 times. 1.85 times. So inventory turnover is a measure of how quickly you're rotating or selling through your inventory. Bigger is better. You want to sell through your inventory more often. So this is absolutely better. We are improving. 2029 versus 2028 is an improvement. And you're always like, the more recent year is the one you're most worried about. You're either getting better or getting worse over time. This is getting better. The next ratio, 365 divided by inventory turnover. I love this ratio, 365 divided by 1.85. So for 2029, it's 197.3 days. And for 2028, 365 divided by inventory turnover, which again, that's our inventory turnover. 365 divided by 1.53 is 238.6 days. This is a measure of how long our inventory is sitting unsold. So last year, 2028, it was taking me around 240 days to sell my inventory. From the day I bought it to the day it shipped off to the customer, it was about 240 days. This year, it's around 200 days. Less is better, right? You would rather your inventory be sitting around unsold for fewer days rather than more. So we are improving. AR turnover, net credit sales. A lot of times we don't have that information, so we just use net sales as a proxy, and that's the top number on the income statement, divided by average AR. Okay, so net sales divided by average AR. Our net sales, top number on the income statement. And this will be different for different companies, how important it is. Like, there are companies that don't make a lot of sales on account, in which case, who cares about their AR collection period if they don't have significant AR? But most companies will have significant AR, and we got to do the average AR. How do you do average accounts receivable? Exactly what we did for inventory. You're going to average these two numbers, 150 and 100. The average there is 125. And the average between 61 and 150, 61 plus 150 divided by 2 is 105,500. I'm just going to put 105.5K. Okay, so I take the yellow number, the net sales, divided by the average net AR. So 2.1 million divided by 105,500, 19.9 times my AR turned over. And for the year before, 1.6 million divided by 125,000, 12.8 times. Okay, what is this ratio telling us? It's saying, how frequently am I collecting my AR, my total AR? How frequently do I collect it? This year was 20 times, last year was 13. More is better, so we did more. I always find this days one or collection period, like days sales and inventory is 365 divided by inventory turnover. This one's 365 divided by AR turnover. So we just did AR turnover, 365 divided by 19.9, 18.3 days. And 365 divided by 12.8, 28.5 days. Like I was saying, I find this ratio speaks to me on human terms, where I say, oh, last year was taking me about 29, let's call it 30 days to collect my inventory or my receivables. When somebody owed me money, it's taking me 28 days to get paid. This year, it's only taking me 18 days to get paid. You for sure in real life, if you're a company or just a real person, you would rather get paid more quickly. So this is getting better, right? We're collecting more quickly from the people that owe us. Okay, so in terms of turnover, and turnover is like a measure of management effectiveness. So inventory turnover, are we bringing in the right types of inventory? Is it selling? Obviously the fact that we got better is a good sign. It means the managers are doing a good job. And in terms of AR collections, this is like, again, is your accounting function doing a good job? You have AR clerks and people supervising them. Are they doing a good job collecting from customers? Do we have good credit policies? How are we doing? Well, this is a measure of that. So these are both management measures. And on this, across the board, management's doing pretty well. I promise there'll be some worses coming, but they've all been better so far. Long-term debt paying ability, the debt ratio. This is just like how much debt do we have? And here, bigger is going to be worse, right? Like less debt is less risky, and we're going to say worse. Again, don't tell your finance professor I said that. So it's total liabilities divided by total assets. Total assets, not total current assets, but total assets. Take the yellow one divided by the blue one, 815, divided by 1751, 46.5, and this is a percent, 46.5% for 2029. And for 2028, 845, divided by 1558. Oops, I kind of missed some zeros there. 845,000 divided by 1558,000. 54.2%. 54.2%. Okay, so if debt is going down, we're going to say this is better. It's less risky. We can say that conclusively in our class. In my class, I say that this is an improvement. It represents a better financial position, certainly a more stable financial position. Again, your finance professors will disagree with that intuition or that insight I'm providing. Times interest earned. This is a measure of can we cover our interest costs? So it's our operating income divided by interest expense. This all comes from the income statement. Operating income divided by interest expense. I'll take the yellow one, operating income, and I'll divide by the blue one, interest expense. So this year it's 500,000 divided by 25,000. It's 20 times. So it's times interest earned. The answer is in times. So 20 times. And the year before, 425 divided by 20, 21.25 times. So last year, I earned enough operating profit to cover my interest cost 21 times. This year, I earned enough operating profit to cover my interest cost 20 times. Is this getting better or worse? The answer is worse. You'd rather cover your interest costs more than less. So this is getting worse. So long-term debt paying ability, more of a mixed bag. That said, I would say if I were looking at this company and I were being sincere in my own belief, even though I got one better, one worse, I would say this one outweighs this one. I would say the better is more important than the worse. And the reason is our debt reduced significantly. Debt dropped by 8%. Our times interest earned is a measure, can we afford the interest bill? And the answer is yes, I can definitely afford my interest bill. And yes, I can definitely afford my interest bill. Marginally more in 2028 than 2029. But this one to me would carry more weight. And so I would say in terms of long-term debt paying ability, because we reduced our debt, right? That would be a sign to me that it got better overall. Okay, on to profitability. The first ratio, gross profit percentage, any retail store is going to monitor this thing super close. For all the profitability ratios, bigger is better. I know I sound like a greedy capitalist when I say it, but that is the truth. If you are monitoring your own company, you would rather have more profit than less. So let's look at our gross profit as a percentage of sales. 1.2 million divided by 2.1 million. 57%, that's our margin, our gross profit percentage, 57%, 0.571. The year before, 950 divided by 1.6 million, 59.4%, 59.4%. Return on sales, net income divided by sales. Okay, so blue one remains the denominator. The yellow one is our numerator. We're going to take the yellow and divide by the blue. So 355 divided by 2.1 million, 16.9%, 16.9%. And 305 divided by 16, 19.1%, 19.1%. Now, I forgot to mention this, and it's worth mentioning. Are we getting better or worse? Well, the gross profit percentage got lower. That's worse. It's not that much worse, but I got to say, a real company, like if it's a big company and its gross profit percentage dropped 2%, it's a bad sign. They will not be happy. And the net income dropping by, again, around 2%. This is worse. Just no doubt about it. It's not hugely worse. It's not like insanely worse, but it's worse, no doubt. Okay, next, ROA, return on assets. Net income plus interest divided by average total assets. Okay, net income plus interest. I'm going to make the denominator here, net income plus interest. So net income, and now I'll just make another line called NI plus int. So net income is 355. Let me highlight those. Net income is 355, interest is 25, net income is 305, interest is 20. So net income plus interest is, what is this, 380, and net income plus interest is 325. And so that number is going to be my numerator, right? Net income plus interest. So I'm going to make this number my numerator in my fraction here, net income plus interest divided by average total assets. My total assets just down here, and I need averages, just like we did with inventory, just like we did with receivables previously. You just average these two. So 1751,000 plus 1558,000 equals, divided by 2, 1654.5K. 1654.5K, and 1558 plus 1455 divided by 2, 1506.5K, 1506.5K. Okay, so net income plus interest, there's our numerator, divided by average total assets. There's our denominator, the yellow number divided by the blue number. 380 divided by 1654500, 22.97%. That rounds up to 23.0%. And the year before, 325 divided by 1506,500, 1506,500, 21.6%, 21.6%. Okay, so for profitability stuff, bigger is better. What is this measuring? It's saying how effectively are we using our assets to generate profit? And so it's saying profit is a great measure for a company, but how well are we using our assets? Because of course, if you're an investor, you're going to be giving money, and you want to know how well they're going to use that investment, how well they're going to use the assets that they have to generate profit. So the answer here is they did better. Now, again, you would be interested not only in how this company is doing compared to itself last year, you'd want to know industry competitors for all these ratios, right, to get a feel for it. ROE, return on equity, net income minus preferred dividends divided by average common shareholders' equity. Okay, so the concept of preferred dividend we covered, I think it was last chapter. It was 2 chapters ago. Chapter 10, I'm going to say. We talked about equity. And what we said was preferred shares often feature a dividend, which is like a guaranteed dividend. And in this case, it's a $4 dividend. They state it when they're listing the various shareholders' equity things, and they also tell you how many shares they have. So they promise to pay a $4 dividend on 500 shares. That means every year there's a $2,000 preferred dividend. Now, when we say return on equity, we're typically thinking of common shareholders' equity, which is why it's net income minus preferred dividends. Why do we take out preferred dividends? Because the common shareholders don't get any of those preferred dividends, right? That belongs to preferred shareholders. The common shareholders, the retained earnings, and therefore the net income of the company belongs to them, theoretically. So that's why net income's involved here. Divided by average common shareholders' equity, and the common shareholders' equity is common shares and retained earnings. So this is a pretty convoluted one. Let's do the numerator first. It was net income minus preferred dividends. So net income minus preferred divs, and it's $355 minus, it's a $2,000 dividend, right? It's $4 dividend on 500 shares all year. So it's $2,000 in preferred dividends every year. Tried to scroll down, something funny happened there. So $355 minus the $2,000 dividend is $353. And $305 minus the $2 dividend is $303, or $2,000 dividend, pardon me. And so this yellow highlighted number becomes our numerator. The denominator, average common shareholders' equity. So let's do we got to do a bunch of math here. Our common shareholders' equity is all the equity accounts excluding preferred shares, which is common shares, retained earnings, typically. And there might be some other, if you take an advanced class, you might learn about AOCI, but we'll leave that for another day, for another class. Here, we're just going to go, okay, 150 plus 736, that's 886. 150 plus 513, that is, 663. And 150 plus 310, that is 460. And now, so that's our common shareholders' equity for the 3 years. Now we need averages. So let's average 663 and 886. 886,000 plus 663,000 divided by 2. The average is 774,500, 774.5K. And the year before, 663,000 plus 460,000. Divided by 2, 561,500. Whew. Okay, so that was a long journey to tell you we take the yellow number, net income minus preferred dividends, divide by the blue number, average common shareholders' equity, and let's do it. 353 divided by 774,500, we get 0.45. 45.6%. And the year before, it was 303. The yellow divided by the blue divided by 561,500. 53.96%. That runs up to 54%. And so this is a measure of how effectively they're using their shareholders' investments. And the answer is, this year 45%, last year 54%. We're getting worse. Now these are really big numbers. But, it's possible, but just they seem like large numbers. But in any event, bigger is better for profitability ratios. We are getting worse, and this is a measure of how effectively they're using their shareholders' investments. As a shareholder, you're interested in this number. The next ratio, earnings per share, has the same numerator, net income minus preferred dividends, so it's the yellow numerator we just did, divide by the average number of shares. And it's saying, hey, as the common shareholder, you have a right to the profit. And this number, more than any other, is the one that big companies like Apple and Amazon and Google and Meta, all, when they're reporting how they're doing, if they want to just summarize, here's how we did in one number, this is the number that investors are very interested in. If you take an intermediate accounting class, you will see this number is very complicated to compute because of the denominator. Now, in our intro class, very easy to compute. Net income minus preferred dividends, so there's our numerator, divided by average number of shares outstanding, well, the common shares. Here's our denominator. There's 10,000 shares all years. So let me erase this previously prepared information. And so we're just going to divide by 10 because the average number is 10. It's 10 every year. Now that gets complicated when you have employee stock options, the company's buying and issuing and buying back their own shares, right? These big complicated companies, it actually is hard to figure out the average number of shares that are outstanding. For our company, though, in this class, it's going to be easy. So I take 353, divide by 10,000. I get 35.3, $35 a share, $35.30 a share. $35.30 a share, and the year before, 303 divided by 10,000, I get $30.30 a share. So, did this get better or worse? Well, is it bigger or smaller? It's bigger. Bigger is better. Whew. So a real mixed bag there for profitability. I can tell you this is like the number that investors are typically looking at first, but it is not a home run here. I would call this a mixed bag as far as profitability goes. Last couple, stock market performance. This is only for publicly listed companies, I would think, because it's hard to get a market price otherwise. Market price per common share. And we have our market prices there, 200, 190, 160. And we take the market price and divide by earnings per share. So for 2029, it was $200 was our market price. Our earnings per share, 35.30, we just calculated. 200 divided by 35.3, 5.6 or 5.7 times earnings. This is a times one. What about the year before? It was 190. Divided by our earnings per share, which is 30.3, 6.27, or we'll call it 6.3 times. Okay, what is this telling us? This is a measure of how much the stock market likes us. And it often has nothing to do with the company itself. It could be to do with global events. You know, if the president of the United States and the president of China say, we don't like each other right now, all of a sudden the stock market goes down. You know, if you're Apple, your stock price plummets because Apple does so much business and manufacturing in China that if the US and China aren't getting along, shareholders will go, oh, this is bad for Apple, right? We want them to get along if you're Apple. And so, you know, it doesn't matter who's to blame, whose problem it is. This CEO will see their share price fall, even though it's got nothing to do with whether the iPhone's any good or not, right? And so this is a measure of how much the stock market likes you. It could be that you just happen to be in an industry that's really hot right now. You know, you were an AI company 5 years ago, and then all of a sudden AI is super hot. Well, your price to earnings ratio is going to go up. So does the stock market love us or not? Last year, 6.3. This year, the measure is 5.7. They don't love us as much. That's worse. That's a bad sign. That means something in our company, or it could be to do with us too. It could be that the CEO has, drinks and drives and gets caught and gets in big trouble. Well, the stock market's going to go down on that news, even though it isn't reflected in the financial statements. Okay, last one, dividend yield. My dad is like obsessed with dividends. If he invests in a stock, he wants them to pay a dividend. So he'd look carefully at this. How much dividend do they pay compared to how much you got to buy the stock for? 13 divided by 200 is 6.5%. So in 2029, it's dividends per share, 13 divided by market price, 200. So it's 6.5% is the dividend yield this year. Last year, it was 12 divided by 190. It was 6.3%. So if you're my dad, you like this juicy yield, you want bigger to be better, and bigger is better. Okay, so we have answered it. And I in terms of commenting, I would suggest commenting on each ratio, just saying whether it represents an improvement or not, and maybe a little why. It depends on your professor. My class, I allow the students just to tell me, is it better or is it worse? But you should be expected to know, like, why is this a good thing to have current ratio go up, right? Or why is it a bad thing that price to earnings ratio is lower, right? So that would be my expectation. But here we have it. We've computed all of the ratios for 12.3b. As always, this is actually it. This is the last video of this series. For goodness sakes, if you made it to the end, thank you for watching. Let me know in the comments if you made it to the very end. I often think nobody makes it to the end of these things. Let me know in the comments you made it to the end. I just want to say thank you. Really, from the bottom of my heart, thank you for watching all these videos. And thanks for making it to the end. You are a rare one. Thumbs up to you. All right. See you in the next video. Maybe see you in the next video series. Congratulations. You're done this course. Goodbye. Well, you made it to the very, very end. Here's a couple more video series you might consider watching next. Thanks again for watching.